Welcome to Chalk Talk, a program aimed at sharing real-world advice and guidance to the private market ecosystem, and especially those companies looking to strengthen their financial foundation and governance. The host of Chalk Talk is Carine Schnieder, the president of AST Private Company Solutions, provider of Astrella, and the most innovative and easy-to-use ownership tracking platform.
Well, welcome everybody. We've made it to March 2023. I'm really excited today to have a special guest, Shari Noonan, who is the CEO of Rialto Markets. And it's great to just spend some time with a woman who works in private markets, who has somewhat of a, not a similar background, but we come from the same kind of schooling in the background. And it's great to just talk about what's going on today and where we see things going. So Shari, maybe give a quick intro to everybody about your background, and then we'll jump into things.
Absolutely. Thank you so much, first of all, for having me. Really enjoy being on the program today and appreciate the opportunity to come and speak. So my name is Shari Noonan. I'm the CEO of Rialto Markets. Rialto Markets really works with companies to help bring private markets to the public. So we work with companies on both private market issuance and secondary trading. And we have a alternative trading system across all private markets in both traditional and digital issuance. My background is in traditional capital markets. I actually grew up in electronic trading. So I worked at a company called Instinet back in the day, and then went to Goldman Sachs to help integrate their electronic trading platform, and then Deutsche Bank as the COO of global electronic trading. So sort of followed that whole trend until about 2015, 2016. And at that point, equities was pretty mature, and I saw the opportunity to move to a new fresh market, which private markets was a great opportunity. So that's when we started Rialto Markets. So
Terrific.
That's the background. Mm-hmm.
Great. Well, I'm so excited to have somebody so knowledgeable on what is happening. Let's just start by getting everybody to understand kind of the breadth and the growth and the size of the market. I looked this morning real quick just to give people an idea. 2021, there were 519 unicorns. And again, we can debate what a unicorn is and how they count it, but about 500. 2022, 1 year later, almost doubled to about 900. And as of February 2023, now we're at 1,200. And I have to say, frankly, I kind of expected that number to be a little less, just because some companies go public or some companies have valuation issues. So let's talk a little bit about how big it is today, and give that kind of base for everyone.
Absolutely. What I find really astounding is just the fact that I think everyone kind of knows heuristically that companies are staying private longer. And we see this with Stripe, we see this with SpaceX, but I'm going to share my screen, so bear with me while I do that. There we go. Okay, perfect. So in this slide, this really is taken from the McKinsey Private Market Report that comes out every year. And what I find fascinating about this is, first of all, that in 2021, $1.2 trillion globally was raised in private markets. But second of all, if you look to 2003, the number was 96. So if you look at the growth trajectory over less than 20 years, really this market has just exploded. And so there are probably several reasons for that. And we can opine about the different reasons for that. So that's the first slide that I think is really interesting and makes people kind of sit back and say, wow, there's a fundamental shift in how capital is being deployed, and a shift in just the movement of capital. The second slide I'd like to show is in the US. So this is taken from an SEC report. This is actually 2022. And this shows how capital was raised in the US in 2022. And so the smaller orange circle shows IPOs. And for the most part, all of the other circles were private offerings. So you had private placements, you had 506C, other registered offerings. So you had other registered offerings and other exempt offerings. So if you look at the IPOs versus the private offerings, you can see private was definitely the place to be in this market. So that is pretty telling in terms of the shift of the market and the shift in terms of how people are approaching the market from an investor perspective, for in terms of an investment perspective, how companies are raising money, how investments are being created. So now if we look at investors, over the last 20 years, and this is really how value creation has shifted. So if you look at the first three companies really went public in the 80s and 90s, Apple, Microsoft, and Amazon, household names. That value creation really happened in the public markets. They went early in their life cycle. The growth stage was still clearly happened in the public markets. Whereas most of the later companies that went public in 2000s, 2012, 13, 2020, and 2021, for the most part, most of the value creation happened in the private markets. And I think people know this generally, that companies are staying private longer, they're staying private through that growth stage. And once they get to the public markets, most of that growth has been, met in the private markets. They get to the public markets and it's no longer there. So, I think what's interesting, and I'm going to stop my share at this point. What I think is interesting is access to the private markets has definitely improved over the last 10 to 15 years. And when I'm talking about that, I mean really the on-ramps and the off-ramps. And I'm including in that, things like self-directed IRAs, the ability to do crowd funds, the ability to access different types of raises, as well as just those core services. And, opening up the private markets to retail investors is really only half the story. So technology allows for the expansion of the market in and of itself. So when you digitize the marketplace, you're able to create completely new fractionalization of all assets. So it's not just creating, allowing a single issuer to stay private for longer, but you can actually create completely new products. And that's where I get really excited, because you think about, when did the equities market really take on a life of its own? The US, what we call it the US equities market. It was when you had the creation of ETFs and the Vanguard. I'll just make a generalization: the Vanguard and ETFs and indices. When you're able to create fractionalization of true alt, now you can have all kinds of investors invest in things in a way that's responsible for their portfolio, in the allocation that works for their portfolio in a completely new and different way. And that becomes really exciting and kind of upends the 60-40 traditional portfolio split. So that's, what we see. And we see that both of these things, with companies staying private for longer, as well as this creation of the fractionalized marketplaces, both of these things are really driving the need for a secondary marketplace in ways that really hadn't existed before. So, we do expect over a period of time that secondary trading will become a de facto requirement for some, types of issuers, especially if they're staying private for a very long time. They're going to have certain stakeholders that are just going to require that. For example, employees. You're seeing this with SpaceX and the tender offers that are happening. But that may not happen in 2023. That might take some time to evolve, but we do see that we do believe that the evolution of this marketplace is going to create the need for secondary trading, just by virtue of the fractionalization capabilities, as well as companies staying private for longer.
Yeah. So one thing I find kind of interesting in the public markets, people are used to stock going up, going down. It happens all the time. I think everybody is kind of given the big boy speech at some point that, you got to put money in here that you can risk to lose. But in the private market, it doesn't seem to have that same feeling of the moment the valuations come down, or, macroeconomic markets are impacting the price. All of a sudden, everybody goes, well, maybe the private market isn't working. Maybe this is bad. So what's your thought about valuations right now? Is it really what you're hearing in the press that, everybody's scrambling and seeing down rounds, or is there kind of a right sizing going on?
That's exactly what I was going to say. I think investors are just getting back to basics, right? I think it's about getting back to basics, which I think is good for the market in the long run. And if you've been in the market for any period of time, you see these periods of sort of mania, and then you kind of come back to earth, and that all right sizes over time. I do think investors, and I do think as this market evolves, and especially over the maybe shorter period of time, investors are looking for access to more information. They're looking for access to more infrastructure. And so we're going to see this evolution and a shift for what investors are requesting and what regulators are requiring in the private market, just as companies stay private for longer. And as there are these new offerings and as there's new product creation, you're going to see things coming down that are around information, access to information, access to data, and that will create that infrastructure for and at scale. So I do think the industry needs to be prepared for that, and that's just going to be a requirement. But I don't think that that's a bad thing. I think that's just part of the evolution of the market.
Yeah, and I've been the CEO of a private company, and you have as well. It's nice to hide behind, oh, we don't have to tell you anything because we're private. But I do think we've seen a number of stories now where there's been bad corporate governance because if you're the CEO or you're a board member of a private company, you feel like you can do whatever the hell you want, and nobody's going to check you. So I do think that there is a time where that's coming very soon.
And I also think that it doesn't just mean to build bigger systems. Right. I think it means that when you have different stakeholder sets, you have to build in those requirements for those different stakeholders, and so you have to take into account what a true retail investor needs and wants in plain language versus an institutional investor, and so that requires thought and not just building something to spit out 10,000 P1s or something like that, right? So it's about being thoughtful in the approach and being ready for it, because I do think it's definitely coming, but I think that's good for the industry. It means it's evolving.
Right. Well, and we are going to get tactical and practical soon about what companies need to think about when they're putting together a strategy with this, because it is still within the control of the company. But let's look at it, let's say 2028, 2029. Where do you see, if you could wave your wand, where do you think the market will be in terms of technology, infrastructure, regulatory? Where do you think this boat is heading?
Yeah, it's funny. So I did used to work on a trading floor, and when I think back to a while ago, when I would walk on the trading floor, there would be a whole floor of NASDAQ traders, and there would be a whole floor of New York Stock Exchange traders, which seems kind of comical now when you think about it. And now if you walk onto a large trading floor, there's, or not even a large trading floor, it's a small section of traders that sort of do everything. And I think in the same way as the market evolves, there's going to be private markets become more mainstreamed, and there's going to be all the infrastructure that's required to support that, right? There are going to be things that are going to be required to be built up around private markets to support that. But I do think that there are going to be that private markets are going to become more mainstreamed in portfolios and more of a part of portfolios, and there's going to be that this traditional 60-40 portfolio will have more alt private investments, different looking types of investments in there that will contain a certain percentage of private securities. And I do think companies will have more tender offers, as they stay private longer, to be able to accommodate. And this will all be an accommodation for their stakeholders, because they're staying private for longer. And, I think liquidity, and I want to caveat this, liquidity will be real. However, caveating this to mean this will come from product creation or as companies become larger. When people say liquidity, when they're talking about private markets, sometimes they think it gets lost. If you're looking at a public security and it's got a $10 million market cap, it's not going to be liquid. It's just not. So, you really need to look at liquidity along really a couple different variables, one of which probably is the market cap and one of which is probably the investor base. So if you have, 5 investors and a small market cap, it's probably not going to be a liquid instrument. If you have a lot of investors and a very large market cap, you're probably going to have a much more liquid type of an instrument. So with that in mind, as things start to be created in this space, there's more opportunity to create liquidity. And as you have more of a diversity of flow and diversity of participants.
Yeah. Yeah, and I see this really going global. I was on a call yesterday with a group in England who are trying to understand all of this. And I think to myself, my God, I've been doing this for so long now. It seems like second nature. But I do think once the world catches up, as you said, the market is just going to expand in terms of the issuers that are out there in the market and supporting it, and then also the participants, the purchasers or investors.
Absolutely.
So one of the things I want to talk to you about is accredited investors and where you think this is going. And in my book, I write about, how I do think the regulators need to rethink some of this. It's interesting, the example I give is an older person who inherits a ton of money, who maybe ran a cement company in New Hampshire, doesn't know anything about really the private market and SpaceX and things like that. They're accredited. They can buy anything they want. And yet the young person who just graduated from medical school, who has a ton of debts and, barely, starting out as a doctor, who probably knows a lot about medical instruments and what would be, or drugs or whatever the next great thing is, cannot participate. So it's not really based on knowledge, it's based on the amount of dollars in your bank. What are your thoughts on accredited investors? And do you have any suggestions of where this needs to go in order to support this growth in the market?
I mean, looking at some of those beginning slides and just seeing the amount of private capital that is, the growth in this market, I do think it needs to be rethought. Now, I do think there need to be investor protections. That is a hallmark of our financial system, and that's why our financial system is so trusted, right? That's why we globally have the respect, or that's why we stand where we are today. So I do think we need to have investor protections. However, I do think it needs to be rethought because of just the vast amount of capital and the shifts in the macro landscape. To your point, when we look at things like Regulation CF or Regulation A, I like how the SEC put a framework around the amount that can be invested. So it's sort of like, you can invest up to within this framework, right? So you can invest $2,500 a year. You can invest 10% of your net worth. And that way you're not putting all of your nest egg into a particular startup that's very risky, but at least you're able to participate in the potential upside growth in a very, potentially lucrative enterprise, potentially not lucrative at all, but you're allowed to make that decision, right? And you're allowed to participate, and you're not stuck in this box over here simply because of, the way that you're classified.
Yeah.
Yeah,
it's I got into a heated discussion with a private equity person at a conference, and I said, what about all these SPACs out there? Who's protecting people from SPACs? Everybody gets, widows and orphans get to do work in SPACs, and yet, they can't go buy Instacart. So it is interesting how we've done this. So let's talk about the technological infrastructure that's been built. So if you're kind of new to this, you've just tuned in, you're the founder of a private company, you're not quite ready for the private markets, but you're hoping to get there someday. How would you explain what's available to a CEO or a founder? What can they take advantage of?
Absolutely. So, I think there's been a lot of progress over the last, I'll call it 5 years, in terms of private market technology and infrastructure, and specifically in terms of and maybe I'll talk about what we see shifts in how founders are raising capital. They're, whereas probably 10, 15, 20 years ago, most founders were doing, the typical friends and family angel to VC, Series A, B, C, D. Right now, what we see is companies are doing potentially that, or, they're doing more, it looks more to me like Lego blocks. They're doing, around, maybe they're doing a Reg CF, maybe they're doing a Reg A, maybe they're doing a Reg D. And so it's a much more, it's a much different type of fundraise, and it's a much different feel to it in terms of how they're building their capital stack. And this is especially true with those companies that have community followings. So those companies that have either, whether it's a retail company or a medical device company, or a company that has built up a following in the way that they've gone about building their business, they have seen a lot of success, or seen some success potentially in terms of raising capital in this way, and then bringing in those investors as either people who will buy the product or become advocates or ambassadors for the company. So that's one thing. This is still early days for this type of raise. The Jobs Act is only 10 years old, so it's still very early days. But I do think there's that type of technology support, and it's either through crowdfunding portals or through self-hosted raises. There's also a lot of technology around, cap table management, around, transfer agents, and that just helps with the management of the company, right? Because as a founder, and I'm a founder, this is tax time. The last thing you want to be doing is spending all of your time on all of the logistics. You want to spend your time building your business. So there's a lot of tools that are out there for founders, and technologies that have come really, I would say, in the last 5 years, that help founders spend their time on the business rather than in the business, doing the day-to-day.
Yeah. Yeah. And just a reminder with Astrella, I mean, blockchain technology has only been in, maybe I can't remember, the last 5-7 years. Keeping track of all those transactions too is so important, and making sure. And it kills me when I see people who are not just that they started the company yesterday, but they've been around for a while. They've got a number of investors. And like you say, they may have come in and out in different ways, that they're still in spreadsheets, and they're relying on that. So what about in terms of if you're, let's say, a Series B, Series C company, nobody's really trading your stock yet in the private market. What should you do if you're like, well, I don't mind supporting this. I've got some employees who've been with me for a while, or shareholders who've been with me for a while, and I'd also like to kind of raise my profile a bit with the institutions. Like, what should they do? Should they just call you, or how does that work?
Absolutely, yes. So we'd be more than happy to talk to them. We have a couple of different ways that we work with companies. So we either have, for companies that have a lot of shareholders, we can run a real-time trading algorithm. It's called a central limit order book. It's a lit book, what you normally see. However, most private companies prefer to do an auction-based methodology. And that's either, quarterly, twice a year, every month, and it's based on what the issuer would like. And they can call a call auction and basically, be able to trade shares at that point in time. So it really provides an opportunity for companies to give their stakeholders liquidity options in ways that, are one, it's an efficient way to do it without getting too many lawyers in a room, and also a way to be able to separate that exit ramp of the company from the stakeholders, which can get to be difficult as you're private for longer.
Yeah, and a question I'm asked a lot is, well, who determines the price? So explain how that works.
Yeah. So the price is determined. It depends on the auction. So at the central limit order book, the price is determined by the actual auction. So it's two-sided auction, and there's a clearing price that's met, and then that's how that works. The central limit order book, it's just based on someone hitting the either buy or the sell.
Right. So and I get this question a lot too. So how does that impact my 409A? Like, am I kind of killing myself by I'm trying to help my stakeholders, I'm being really nice, I'm being supportive, and then wham, my 409A goes
Yeah, and that's exactly why we work with companies we work with companies to make sure that their 409A is not impacted. So the way that we're different from some other providers is we make sure that the issuer is listed on the platform and not take securities just to trade them and potentially impact the
like a pre-clear or something.
That's right. We pre-clear it.
Yeah, got it. Okay. In terms of the liquidity programs themselves, I get a lot of questions on this. When do you think a company should start to think about some kind of a formalized process, and how often do you think they should make this available to their stakeholders?
So in general, I would say quarterly is generally what we see. It's a quarterly event, and that's what we see that happens most often. In terms of the life cycle of the company, it's around. Again, it depends how long the company's been around and how long those investors have been around. But in general, it's around the Series B, Series C timing.
Okay. And is there a valuation kind of minimum that you see companies are worth like 200 million, or you don't see a number like that?
And not generally, no. We don't have a valuation minimum. There are some other things from we do have requirements for the ATS. We are registered with the SEC, and so we have a process that we go through as we work with issuers, but that's an individual process that we go through.
Okay. And what if you're a non-US person who's interested to get involved? We always have people call in from outside the United States. What's your recommendation there?
As an investor or as an issuer?
Both. Let's take both.
So as an investor, absolutely. We work with non-US investors. We have a matrix in terms of where you're coming in from. There's a risk matrix. So depending on what country you're coming in from, we can work with you. And obviously sanctioned countries we have an issue with, and then there's either high, medium, or low risk countries. And in terms of issuers, it depends on the country you're coming in from, and but in general, we're working with US companies. Okay. Mm-hmm.
Yeah, it's and I'm sure that'll change at some point as well.
I was going to say we do work with some partner exchanges and platforms. So if you are an international company, reach out and we can talk through that.
Okay. So what about the regulators? And let's talk the US regulators, obviously. We talked a little bit before as we were prepping, we see this coming down the road. They're really trying to study this and understand it. You've been a lot in the public market side. Now we're in the private market side. Where do you think the regulators are in terms of understanding what's happening, wanting to get involved, wanting to start issuing more regulations? I mean, like you said, they did Jobs Act, they did crowdfunding, we've got Reg A. They just revised some things, but where do you think, are they getting more involved, or are they still kind of like hands off? This is the private market, we're just going to let it be?
I do think they will get more involved. I mean, to be honest, I think the regulators have their hands full right now with a lot of different areas. But I do think, let's call it 2 years, 2 to 3 years, we will see some guidance just because this market is quite large. And so I think we're going to see, meaning private markets overall, I don't mean a particular segment of that private markets, but do you think we're going to see some guidance that's going to start shifting how this market operates and some of the requirements around whether it's disclosures or reporting?
Mm-hmm. Mm-hmm. Yeah, and I think too, the one thing we haven't talked about is kind of where crypto comes into all of this. We get asked a lot by companies, not a lot, but there are companies out there that say, we don't want to settle in equity and we don't want to settle in cash. We may want to settle in crypto. And this is especially obviously companies that are very involved in the crypto world. Where do you see that fitting into all of this? And do you see a future where crypto is going to get more involved, perhaps helping with settlements or things like that? Or do you think it's going to be kind of separated off from the private market?
So we are a digital securities alternative trading system. So that what that means is we work with blockchain-based technologies, and from a securities perspective. So if it's a security and it's blockchain-based, we can work with it. We've also worked with some stablecoins, and however, I would say over the last 6 months, there's been a lot less interest in the stablecoin world. I think there probably will be, over a period of time, a resurgence and interest in that, from various different groups. And we are, prepared and ready to work with that. It's just, people need some time to digest what's happened and work through that.
Yeah. Yeah. I'm on a committee of kind of people who are thinking about the future and all of this. And one of the things that everyone's talking about now is the speed to settlement. So you're going towards T+1 in the public market. People are, Venmoing each other and getting instant transactions. But the private market, you're still looking at, in some cases, months to settle. And so, is it the technology that's going to speed it up? Do we need to talk to the lawyers, or, do you think something like crypto could potentially help speed up settlement as well? Though, you can wire money, obviously, without any problems.
Absolutely. And, I was talking to someone in the public markets last week, and they said, there is this push to T+1, and we're actually pushing to T+0, because why are we inching, right? So we're going to have to redo all the systems to get to T+1, and let's just rip the Band-Aid off, right? And so in the equities world, which I'm very familiar with, in that settlement system, it is sort of, it was eye-opening when I came to the private markets and really saw the length of time and the breaks, the operational shifts, and just how much was done on an analog basis, and the opportunities really for efficiency. I do think that's the basis for why we looked at the digital securities route. First and foremost, it was because of the operational efficiency that you gained. Because it was a greenfield approach. Private markets really didn't have anything from a technical perspective underpinning it when we got involved, and so you could really start fresh rather than trying to apply something to the public markets that already had a big infrastructure that had been around for a while. So I do think that there's a huge opportunity there for much more efficiency, which would drive both a lot of cost out of the system, as well as a lot more, again, product creation, ability to innovate. So in ways that you wouldn't be able to innovate with the cost structure, as it exists.
Yeah. Yeah, and we see that, and we're developing our connection with Rialto so that our Astrella clients who want to do something with Rialto will have that immediate link to be able to move data back and forth. But I'm still surprised that for most of some of our competitors, it's all still manual. They're downloading spreadsheets and they're emailing spreadsheets to each other, and APIs and things like that solve all of that. But all of this needs to come together. I also think I was talking to a bunch of lawyers yesterday about how many lawyers there are to get something like this done, like to get a liquidity. It's a 3-party transaction. It can sometimes be a 5 or 6-party transaction, depending upon how many buyers there might be. So that's just cost, and that's time, and all of that. So definitely looking forward to seeing that improve. And hopefully we'll get to a point where, I don't know if it'll be T+0, although I don't see why not. But why you can't go in and say, I want to buy these shares in a privately held company, and that you should be able to see them in your self-directed IRA, within a day or two. It should just be deposited into that account. Just quickly, I'm always a fan of self-directed IRAs getting involved in this. How are you seeing a growth there? Are you seeing people starting to understand that that's an opportunity for them to take some cash and invest in the private market?
Absolutely. I would say roughly, and we just started tracking this, but roughly about a third of recent raises Yeah. So it's been a big growth area.
Yeah, it's such an untapped market too for companies looking to raise capital. I always talk to our founders and our clients, and say, it doesn't just have to come out of somebody's bank account; it could come out of their retirement account. So that could be very exciting. Well, I always end up with asking one question, and that's our pearl of wisdom from our guests. So, if you were going to tell somebody it was not they're new to the private markets, what would you say is probably going to happen in the next year to two, and how should they participate and prepare? What kind, let's say it's your 18-year-old niece who's sitting there saying, I want to get involved, and let's just assume they're accredited. What would you
Yeah, I think what I would say is private markets definitely are growing so much faster than public markets. And what I've said and then seen from people that I've talked to about this is, when people start lifting the hood and looking at this, whether it's individual companies and looking at individual companies in private markets, or whether it's some of these new offerings, it's a really intriguing way to invest in a different way. But I think it is also important to realize it's fundamentally different, and the regulatory construct is different than your traditional public markets. So you need to be aware of that and be aware of sort of the risk profile that you're walking into as you're walking into the private markets. But I think it is the future of where we're going. We just need to be cognizant of where the infrastructure that's required to get there, because I think it is the future, and I'm excited to be a part of building it.
Yeah. So we got a question I want to ask you before we end. Somebody asked, do you see ETFs getting into this market?
I do. I actually see a lot of the major players, in whether it's asset managers or private equity players, getting into this market. I think the two ways that we're either working with or seeing or hearing about or speaking to folks on the asset management or private equity side looking at this is they're either looking to expand their distribution network, meaning get to a retail base that they can't get to, or get to another investor base that they're not currently able to get to, or they're looking to create a completely new product. So, my favorite example is, a lot of private equity firms, or several private equity firms, bought music catalogs. And you can imagine taking that music catalog, slicing a slice, and being able to sell that to the fans, being able to take those royalties and distribute them to the fans. That would be a really cool alternative investment, and neat thing to be able to offer out. So those are the types of things that the asset managers and private equity firms are speaking about, that are sort of similar from that perspective. And from a product creation perspective, from an ETF perspective, we are seeing funds being created that are private market funds that are a collection of private market companies as well. And those can either be interval funds or other types of funds.
Yeah. And I think there's the Shares Post 100, which is, trying to pull those together. And there's other funds like that. The one I'll share with you that I found interesting, I was talking to a very large private equity firm in another country, and what they want to set up is some kind of, I don't want to call it crowdfunding because it's the wrong thing to say, but they're looking and saying, well, look, why can't we open up a fund where people could invest as little as $2,500 or $5,000 and get into the private equity space and participate in that way? And that would be a whole new source of funds for us. Now, of course, you got to deal with all these LPs and, how do you administer all of that? Of course, that's what we were talking about, is how do you track who these people are and when can they get in and get out and all of that. But, you see somebody like private equity starting to think about this, and you realize that, it's going to be an interesting 5 to 10 years. So I'm enjoying this. I think this is the new frontier, and I'm glad I'm here. So Shari, I want to thank you for your time today, your knowledge. This was really great. I really enjoyed it. We have our next Chalk Talk coming up at the end of March. This is a double header for us in March. We're going to have Rich Moran joining us. Rich is the former chairman of Portal Software, and he was a VC with Venrock, and he was the president of Menlo College, and he's a Renaissance man, and he's an author. His new book, Never Say Whatever, is coming out. And for anyone who tunes into Chalk Talk and actually signs in, they'll be getting a free copy of the book sent to them. So we're going to be talking with Rich about how to build a board and how to build effective advisory boards, board of directors, when to get people on, when to get rid of them, all of that. So Rich serves on so many boards. He'll be sharing that knowledge with us. So looking forward to that. Shari, thanks again, and appreciate everybody calling in, and we'll see everybody next time. Thanks so much.
Thanks so much. Have a great day.